Thank you, Chairman Frank, Ranking Member Backus, and committee members for the opportunity to present the Treasury Department's perspective on recent events in the credit and mortgage markets. We have been experiencing capital markets turbulence that will take some time to work its way through the economy. It is significant that this is happening against the backdrop of strong U.S. and world economies. U.S. economic fundamentals are healthy. Unemployment is low, wages are rising, and core inflation is contained. Although the recent reappraisal of risk, coupled with the weakness in the housing sector, may well result in a penalty, the fundamentals point to continued U.S. economic growth. Unlike similar periods in the past, current events weren't precipitated by problems in the real economy, but by excesses in the credit markets. We should put the current situation in perspective. Innovation in housing finance has made credit more widely available, allowing millions of Americans to buy homes they can afford. Home ownership in America has increased from 64% to 69% since 1994. Even in the current environment, the vast majority of new homeowners will not have difficulty keeping their homes. The President has announced an initiative to help those homeowners who are struggling. He called for the FHA Modernization Act, which Secretary Jackson will describe, and he called for tax relief to prevent homeowners from being hit with a tax bill due to debt forgiveness on their primary residence. I am pleased to see progress on the FHA bill and urge action on the tax bill as well. President Bush also tasked us to work with mortgage counselors, servicers, and lenders to help as many Americans as possible keep their homes. We have learned a great deal from our meetings so far. First, it is clear that while adjustable rate prime mortgages are the most at risk, some prime borrowers with solid credit histories are also struggling. Second, we learned that lenders are proactively contacting homeowners facing an interest rate reset that they likely cannot afford. Yet those calls often go unreturned because many homeowners mistakenly think that their lender wants to repossess their home in foreclosure. In fact, the opposite is true. No one likes foreclosure. It is tough for families, it hurts neighborhoods, and it is also unprofitable for lenders in most situations. Finally, we learned that 50% of foreclosures occur without borrowers ever talking to their lender. When borrowers don't seek solutions until after they have missed payments, they will have far fewer financing options. And so the most crucial message we can send is to the borrowers who are missing or concerned that they will miss their mortgage payments. Call your lender or a mortgage counselor today. And when all of you are in your district, when you talk to the local media and your constituents, please send that message. The earlier borrowers reach out, the greater the possibility that they will be able to modify their mortgage into one that allows them to stay in their home. The GSEs play a significant role in the mortgage market. We should examine their authorities and ability to assist. However, the extent of possible GSE assistance is complicated by their unique structure and the need for regulatory reform. Currently, the conforming market in which they operate is performing well. That should not be a surprise. Investors avoid the credit risk of the underlying mortgages when they buy agency-guaranteed mortgage-backed securities. Therefore, if the GSEs are to assist in the markets that are not operating normally, it would involve an expansion of their authorities. The GSEs are an unusual construct. They answer to shareholders and have a congressionally mandated mission. As we consider any change in their role, we must always balance these imperatives: the temporary needs of today's market, the legitimate policy question of how much of the mortgage market should be directly or indirectly influenced by GSEs, which are misperceived as being backed by the federal government, and issues of size, systemic risk, and longer-term market distortions that will occur by inserting perceived government-backed intervention. Because of the size of the GSEs and these related issues, any legislative expansion of their role must also correct the inadequate GSE regulatory structure. The current GSE regulator has less authority than a federal bank regulator, But the solution is not to regulate the GSEs as if they are banks. The GSEs regulator should have more tools available than does a bank regulator to take into account the unique characteristics and tensions of the GSEs.